Hello and welcome. I'm Craig Harrington, and today's topic is how other countries block foreign acquisitions. On March 17th, the Chinese government rejected a buyout offer of that nation's largest juice maker by American icon Coca Cola. This exemplifies the double standard China operates under in regard to foreign direct investment and protectionism. Last September, Coca Cola offered to buy Huyan Juice Company for approximately $2.4 billion. The acquisition would have been the largest foreign takeover of a Chinese company in that country's history. However, the Ministry of Commerce rejected the takeover bid, citing antitrust laws. In a statement released the day after the rejection, the Ministry of Commerce said that it feared Coca-Cola would set up some exclusive terms to restrict competition in the Chinese juice market. The acquisition would have increased Coca-Cola's market share, but it would have only increased it to about 20%, which is not exactly monopoly status, and is nowhere near the market dominance that some Chinese companies have in the United States. China's move to block the acquisition is just the latest example of its own double standard on foreign investment. China, via its enormous sovereign wealth fund, has been using the global recession to acquire beleaguered companies and assets around the world, particularly in the United States. But when an American company attempts to buy a Chinese company, the deal is scuttled based on some arbitrary law or restriction. Both Ministry of Commerce Secretary Yao Jian and Foreign Ministry spokesman Xing Gang claimed that the rejection was not based on protectionist fundamentals, but on a desire to maintain fairness in the market. But there is nothing unfair about protectionism. But when one country is protected, like China, and its trading partner is unprotected, like the United States, the entire system is out of balance. Japan is another of America's largest trading partners, and it too utilizes investment barriers to protect its domestic industries. The government there uses strict controls to limit mergers and acquisitions, portfolio investments, and lending. These measures were originally motivated by a desire to prevent Americans from gaining too much ownership in the Japanese economy. One of the ways in which the Japanese prevent hostile takeovers is by utilizing a system of cross-holdings. Companies all hold stock in one another's companies, making it nearly impossible for any one to gain a controlling interest. This system also promotes a stable business environment because everyone rises and falls with the same tide, so they all work diligently to assure mutual benefits. This practice worked so well that as of January 2008, foreign direct investment in Japan represented just 3% of its GDP, while in the United States, foreign direct investment represents 14% of gross domestic product. When you factor in the relative size of the two economies, you see roughly 15 times more foreign money in the United States than in Japan. In addition, Japan also uses rigorous standards, testing procedures, and government procurement policies to impede foreign capital from entering their market. Meanwhile, all of America is up for sale. From July 1978 to July 2008, America sold nearly 17,000 companies to foreign investors. The jobs go to foreign workers, the profits go to foreign companies, and the tax revenue goes to foreign governments. This is certainly not a recipe for success. America should follow the lead of the Chinese and the Japanese and begin taking steps to protect its vital industries, companies, and assets from hostile foreign takeovers. China and Japan operate their economies in an economic war, and it is time for the United States to join the fight. On behalf of concerned citizens, I'm Craig Harrington. For more on this and other news topics, please log on to economyincrisis.org.
Wake up, America! Open up your eyes! Wake up, America! Wake up!
Produced by economyincrisis.org.